Okay, this clip is from Adam Parker and Trivariate Research, and this is critically important to what we're going to talk about here in this video, following news that Mike Wilson and Morgan Stanley just turned bullish, but like ultra bullish.
I wrote that on Sunday.
Yeah.
Is it going to be a sell the inauguration? I had this dinner Tuesday night. During the appetizer, I was like, maybe it's January 1st. And then during dessert, I was like, maybe it's the Monday after Thanksgiving. I was like, because as I heard, like everybody,
heard from
everyone was so bullish. I was like, whoa,
right.
You know what I mean? Because, I think we all remember that first couple trading days of 23. People forget now, but Nvidia and Meta were awful stocks in 22. They were down 50, 60%.
Yeah.
And the correct move, if you were God, was cover December 30th and long max on, so I think a lot of people were worried there just could be like a bit of a nasty rotation early next year, and they're just sort of hoping that it lasts. And then I start thinking, well, if I'm aspirationally average PM, and I think that now, maybe it happens 2 or 3 weeks before. And I just, I'm just trying to. It's all game theory at this point, but I am a little worried.
So you might revise this idea when you see the Goldman Sachs and the Morgan Stanley.
If they're all bullish,
2025.
I don't see how I can justify being bullish for the first half of next year, or at least I will be. If there's a 20 variable problem, I'll weight that sentiment variable more heavily.
Yeah.
Because that wisdom of the crowds has been like wrong. The best thing, what's the best thing? You're a contrarian bull and you're right. And that's like nirvana.
So that's like that's the Belsky moment.
That's the best.
You're the only bull.
That's the best. Contrarian bull and you're right. The worst is, obviously you're out of consensus, bear, and you're wrong.
So what he just said is if Morgan Stanley and Goldman Sachs put out their 2025 year-end targets and they're bullish, then it's going to be really hard for himself to be bullish as well, because at that point, pretty much all the bears have thrown in the towel and we're all consensus bullish at that point. Well, I'll be damned with what just came out today. Here's the headline. Morgan Stanley finally turns bullish on U.S. stocks as it says the S&P 500 could jump as high as 7,400. The Wall Street firm expects the recent broadening in earnings growth to continue in 2025. This article says perhaps better late than never. Morgan Stanley has jumped on board the U.S. train, moving its rating on U.S. stocks to overweight and targeting 6,500 at the end of 2025, compared to June of 2025's target of 5,400. In fact, its new base target is above its previous bull scenario, which was 6,350. Now it says the S&P 500 could jump as high as 7,400 next year. That is the bull case scenario. That would be a 24% rise in the S&P 500, with a base case scenario implying almost a 10% rise and a bear case scenario implying a 23% fall to 4,600. This article goes on to say why the change of heart. Well, the firm still says valuations are richer than they used to be. Quote, valuations should be richer than 6 months ago because markets have grown more certain that fundamentals are good, and valuations can be richer in 6 months' time when investors see that fundamentals are sustaining by solid macro, the firm said in its 2025 outlook. U.S. exceptionalism will continue, the firm argued. The multiple on 12-month forward earnings will contract slightly to 21.5 from 22.2, but remain at a premium to the 10-year average. Quote, our work shows that it's rare to see significant multiple compression in periods of above average earnings growth and accommodative monetary policy. They expect 13% earnings per share growth next year and another 12% in 2026. They say, quote, we expect the recent broadening in earnings growth to continue in 2025 as the Fed cuts rates into next year and business cycle indicators continue to improve. A potential rise in corporate animal spirits post the election, as we saw following the 2016 election, could catalyze a more balanced earnings profile across the market in 2025, according to the U.S. team led by Mike Wilson. It was also interesting to read the firm's take on the Department of Government Efficiency and its leaders, Elon Musk and Vivek Ramaswamy. They say, quote, while many are skeptical they will be able to actually cut spending via efficiency efforts, we think it makes sense to take a more open-minded approach given the individuals involved and the fact that this seems to be a focal point for Trump in his second term. They said, with the jury being very much out on the ultimate outcome, we think term premium will tell the story of how the bond market is thinking about this issue, referring to the excess return investors require for taking on interest rate risk. Morgan Stanley is also bullish towards Japanese equities. So yeah, long story short, one of the biggest bears on Wall Street is now bullish, and not just a little bullish, but very bullish. And it's kind of one of those situations where, if you guys have been in Wall Street for a while, you understand this. The market tries to screw as many people as possible. The consensus view is usually not correct. Think about this in terms of options, perhaps. If you win big on an option, someone loses big on an option. Well, if everyone is betting that, say, Nvidia will go up after earnings, for an example, if there's like a 95% of options to the bull side and 5% to the bear side, even if things are great, the stock can only go up so much. Those 95% of bull options, let's call it, can only go up so much, because who's paying out the rise for the 95%? It's going to be the 5% that we're shorting against that. It's going to be the, 5% of people on the losing side of that trade. So you can only make so much. Whereas if everyone's, bullish for that matter, 95% of options are bullish and the stock craters, well, you're essentially having 95% of the options paying out to 5% of the winners. That's where you can get these large returns if you are a contrarian in certain situations. Well, same is true for the markets. If everyone is bullish, there's not too much to, fuel that upside, right? Because there's not many people on the other side of that trade. And that's why when everyone is so skewed towards one direction, usually that outcome does not happen. Or if it does happen, it doesn't happen as much as people think, because you can only win so much if everyone is winning. And that's really the big catalyst for this week. It's Nvidia earnings. Now, there was news over this weekend that Nvidia's Blackwell chips are overheating, and this has many of the prospective buyers of these Blackwell chips concerned that they're just going to get these chips and not be able to use them for an extended period in time, or maybe the design changes and they're unable to use them entirely. Well, Michael Dell, Dell's CEO, he says they've already started to take delivery of these Blackwell chips. That is alleviating some of the concern that investors have today about these Blackwell chips. You can see here the first server racks with Nvidia's new Blackwell AI chips are now shipping, according to Michael Dell. Specifically, Nvidia earnings, I think there's a lot of uncertainty here. And let me explain why. We've talked about this in previous videos, so I won't stick on it for too long. But there's uncertainty about what margins are going to look like because of pricing. Think about it like this. If there's so much demand for Nvidia and it takes a long time to get these Nvidia chips, AMD and other competitors are starting to create chips that are more comparable. Okay, they're not as good as Nvidia, but they're more comparable. And they're selling between $10,000 and $15,000. They're a lot cheaper, albeit, than Nvidia's chips. And presumably you can take delivery of these AMD chips a lot sooner than Nvidia ones. Okay, so what does that mean for pricing of Nvidia chips as other competition starts to come in? Presumably, pricing is going to fall. These H100s, H200s, Blackwells, they're not supposed to sell for $30,000 to $50,000 a chip. They're MSRP between $8,000 and $15,000. They're overinflated because of all of the demand. That's why Nvidia has had the margins that they have had. So that could bring on some margin pressure. I think that is an uncertainty around Nvidia earnings, and I think guidance will be important for that. Margin guidance as well as top line revenue guidance as well. Does Nvidia see pricing being compressed over the next year. Now, if Nvidia does not provide 2025 guidance, as most other companies are right now, that would be an issue in and of itself. So that's something I'm personally going to be watching for. Also have the simple problem of Nvidia's growth rate slowing down. And that's what Wall Street really likes to see, is a growth rate that's accelerating. And Nvidia is just getting to the law of large numbers here, where their year-over-year comparisons get a lot more difficult because, I mean, in the year-ago quarter, they started doing really well, right? So it's a good problem to have, but it's still a problem nonetheless for a stock. It makes owning the stock a little bit harder if, let's say, you've been growing at 100% year over year, and now you're only going to be growing at 50% or so, or 25%, right? The growth rate is going to slow down. And typically, even with good companies, great companies, the best companies, as Trump would say, you do see when the growth rate slows down, the appetite for owning that stock also slows down. Mix in there what could be some pricing pressures, and you could have a negative cocktail brewing for Nvidia. Top that off with everyone being long Nvidia, everyone being bullish on Nvidia, and you have a maybe not so positive setup for Nvidia earnings. Now, over the past week, as far as hedge fund and institutional option activity, you have seen 2,795 different trades totaling $2.11 billion with a positive order value of 81%. Now, I'm sure retail perhaps is roughly as positive as this. So you have about a 5-to-1 ratio of calls versus puts, or bullish activity versus bearish activity. So you're set up in an unfavorable way heading into Nvidia earnings. What's actually interesting is the options market sees more risk for the S&P 500 from Nvidia earnings than from the next jobs report, CPI, or Fed meeting. Nvidia remains the most dominant stock in the markets, driving 20% of the S&P 500's return over the past year, and is expected to drive nearly 25% of the large cap index's EPS growth in the third quarter. A Bank of America strategist led by Equity Link analyst Gonzo Asis said in a Monday client note. He says, quote, "With the market taking a breather last week following the election rally, we believe Nvidia earnings can dictate the near-term direction of the market." They say, given single stock fragility on the rise and easing post-election euphoria, the Bank of America strategist said it is, quote, "sensible to hedge the potential added impact on the broader market in case Nvidia disappoints." Now, is Nvidia really going to disappoint? Probably not. They're going to beat on the top. They're going to beat on the bottom line. They're probably going to beat on margin as well. But that doesn't matter. It's all about what is next. And that, I think, could be somewhat problematic just on the terms of the growth rate slowing down, which is going to happen. So I'm also under that same assumption of Bank of America. I think a hedge here could make some sense given the extreme amount of volatility that we're going to see if the markets are disappointed. And now that you have even some of the biggest bears in the past couple of years throwing in the towel that are now bullish, I think it really adds to that risk here that now everyone is in the same boat, and it could be ripe for a bit of a reversal. Now, I do want to go back to the earnings calendar here, brought to us by Earnings Whispers on X. Tomorrow morning, we have Walmart and Lowe's earnings. Consumer stocks are big this week, in focus in this earnings season. Even on Wednesday, you have Target and TJX. Now, Walmart is specifically important because, let me take you back in a little bit of history. In 2007, the March through August quarters, both of those quarters, Q1, Q2, Walmart started to warn about a consumer that was slowing down, that was pretty rapidly slowing down. Wall Street shrugged it off for a while. Now, in that August quarter, Wall Street took notice. Market sold off 3% after Walmart's warning about the consumer and about a potential upcoming recession. And then what happened? The Fed cut rates 50 basis points September 18th. Markets rallied 3 weeks after that And then the dookie hit the fan, okay? That's when Wall Street started to say, oh crap, maybe things are not that great out there. And it did take some time. But the first real warning we had of this was from Walmart, and rightfully so. Walmart is the economic barometer. I think Walmart earnings, just put it this way, are more impactful, more accurate than economic data that we get, than any economic data set. No matter if it's surveys, no matter if it's hard data from the government. I mean, the BLS jobs report, like 30% of businesses report their actual hiring and firing. The rest is like a poll, like an election poll that they were all wrong. It takes a couple hundred businesses, couple thousand businesses, whatever the number is month by month, and extrapolate that for the rest of the economy. That's how the data works. Is that very accurate? Probably not. Now, Walmart's going to give us a much better indication of just how good or bad things are. Now, Walmart has said things are great for a while now. Do they change that sentiment? That's the question. Other question is, does Wall Street pay attention to this the way that I am paying attention to this? Now, the bottom line here, if Walmart has good things to say about the consumer, you should be more bullish on the economy. That's not financial advice. That's just my opinion. That's how I'm looking at this situation. If Walmart is negative on the consumer or starts to kind of change their stance, then that is absolutely something you want to pay attention to. That is absolutely a warning sign for the economy. And at that point, I'll keep you guys in the know. You know, whatever happens tomorrow morning with Walmart, I will cover it. I listen to the earnings call. I listen to everything that has to do with Walmart. It's that important. If there's any changes, I'll let you know. But I think this is a critical quarter as we head into 2025 and get even guidance, presumably, for 2025 from Walmart. Now, Target, TJX, they're not as important. Target kind of has its own demographic. Things are a little more expensive, right? Target's a little bit different. TJX is basically takes the products that Target, Walmart, other retailers don't sell. They get them for a discounted price. They sell those there, right? So that's kind of more lower income consumers, kind of like Walmart as well. But I think Walmart is the holy grail of consumer names for this week, and it just happens to be tomorrow morning. Now, here on the day today, the percent of stocks currently trading above their 50-day moving average has really just been ping-ponging back and forth in recent months, anywhere from 45% or so on the low side to 73% on the high side. Today, you're at 55.5%, which is kind of on the lower end side, but it's still in the range of where we have been over the past couple of months. You're actually up today. So 1.71% of stocks are breaking above their 50-day moving average today. This is 100, 200 plus stocks that are breaking above their 50-day moving average. That's a good sign. It's not a great sign, but it's a good sign that indexes are moving higher today. Some stocks are also moving higher. Now, CNN's Fear and Greed Index is interesting. You're sitting at 50 today, which is the exact same as yesterday. You have fallen a lot recently. 1 month ago, you were in greed territory at 74. Now you're only at 50, which is exactly in the middle of neutral. Market momentum is greed, and this is the S&P 500 and its 125-day moving average. Stock price strength is in extreme fear. This is the net new 52-week highs and lows on the New York Stock Exchange. So in other words, you're not seeing a lot of stocks breaking out to a new 52-week high. This is not happening right now. Stock price strength, extreme fear. Put and call options is neutral. Market volatility is neutral. Safe haven demand is greed, and junk bond demand in extreme greed. This is something I have talked about over the past, couple of days specifically. It's the VIX. The VIX has collapsed ever since the election. Now, heading into the election, the VIX was too high. It was at 23 at the highest point. That's like typically when your full-blown correction or crash is when you're, 23 to 30 or so, or like 2022, right? During that whole year, you were pretty much within 20 and 30, okay? There was a lot of fear. I think too much fear. I expected the markets would rally after the election and the VIX would come down. Now, did I expect it to come all the way down to 15.40? No, because I think we are in a high risk environment, or a higher than normal risk environment. If you look at a new, presidential candidate, or at least, a changeover, right? With new policies, some being good, some being bad. I mean, we could see a new trade war for all we know, right? I think long-term Trump's going to be great for the economy and all of that. But eventually there will be a freak out period because of a potential China-US trade war, which actually happened in 2018. Markets fell 20%. We've seen this playbook before, okay? We have to face it. There's uncertainty about the economy as well. A lot of people have thrown in the towel and joined the optimistic camp. Even, again, Mike Wilson today being a major red flag of that. We won't know if we're actually going to have a soft landing for probably the next 6 months or so. We got to give the economy time, give the data time to, in reality, catch up to what has been happening in the economy. The economy is a slow-moving boat, but the data moves even slower than that. And I think for even just these reasons, we shouldn't be so complacent. The markets are just being complacent at this point. And I think we are in a higher risk environment, and that does command more hedges, right? And you're just not seeing hedges out there on the marketplace. And I think you are vulnerable for bad news at this point. Again, everyone being in that bull camp puts you in a not great position from an equity risk reward kind of place. Now, Tesla had a great day today, did very well. I think Tesla is probably going to continue to break out from here. I think today's a great example of the relationship between Tesla and Nvidia. I talked about this in prior videos, but for a while there, when Nvidia would go up, Tesla would go down. It's like Nvidia was draining the liquidity out of Tesla. Well, as Nvidia potentially comes down, investors are going to start focusing on, okay, what company is actually putting to good use the investment they have made into Nvidia chips? And that is clearly Tesla. Now, the news we got today that the Trump administration is going to make it easier for full self-driving and robo-taxis to basically operate and to get approval, that was great news for Tesla. And I think that news in and of itself has legs to move higher. Now, come Wednesday, if Nvidia does disappoint on earnings, it could take Tesla down initially, but it may also propel Tesla. Okay. So I think that's a big question mark, whether Nvidia would drag down Tesla or actually fuel Tesla to the upside. If today is any gauge, it could actually fuel Tesla to the upside. So a disappointment from Nvidia could be good news for Tesla. And I think over the next 6 to 12 months, if Nvidia does take a back burner, Tesla starts to obviously take front and center more of the investment attention. That is going to help drive Tesla stock higher. Now, let's also keep in mind relative performance, right? A lot of your other big tech stocks have done very well in the last couple of years. Tesla's still down from its all-time high. Now, some people will argue Tesla shouldn't have been at 414, right? That shouldn't be the all-time high. But regardless of that, Tesla's still down like 20%, close to 20% from its all-time high. And I think there is plenty of room to take that all-time high and potentially even run into the 450s, maybe 500s. I think by the end of 2025, as long as we don't have a recession, everything progresses as planned. 20-30% delivery growth next year. Optimus getting closer to, larger scale production, robo-taxis in California and Texas, hopefully more states than that, but gaining ground. You're going to be looking at a Tesla that is a $600+ stock. Now, in the near term, I think things look good. There's uncertainty about Nvidia earnings. If you're a long-term investor, this should be music to your ears because I don't think Tesla is going to fall materially from here, although I do expect a correction at some point. Tesla does not have to correct if the markets do. We've seen that before. Tesla can take leadership if the markets correct. So I think there is a lot of uncertainty, a lot of, potential open-ended, questions. What's going to happen with Tesla? What's going to happen with the broader markets? I do think Tesla's going to be just fine. I think you've consolidated the recent gains from that fall you've seen from $358.64 down to about $310 or so. You're back up into the 330s. I think you consolidated that, and you're likely set for another move higher. I talked about this yesterday, but the technicals for Tesla on the 1 hour candlestick chart looked really good for another move higher. You kind of gap up, trade sideways, gap up, gap up, gap up, gap up, down, down, down. And now you started to kind of reverse that on Friday, and you've seen an even bigger kind of up move today. So 2 days in a row of gains is definitely looking pretty good for Tesla for the next couple of days. But again, a lot of uncertainty there. And you guys will have to let me know your thoughts down below in the comment section. I do think if you look at the technicals from the 1 hour candle chart perspective, it does look like Tesla wants to continue to break out to the upside here. But that is obviously just my personal opinion. Let me know what you guys think down below in the comment section. Specifically, would a correction or market downside take Tesla down? Or in other words, would Nvidia disappointing on earnings, potentially falling 5 to 10% in the following days after earnings, drive down Tesla stock or be an accelerant to push Tesla higher? I would love your thoughts down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.